When I open a bank reconciliation, I'm not thinking about just matching amounts. I'm trying to answer one thing. What is the real cash balance of this company? Because the bank balance is not the answer, and cash book balance isn't the answer either. The reconciliation exists to explain the difference and get us a number we can actually trust. Let me show you how I review one in practice. Alright, on the screen, this is a full bank reconciliation for the month ended October 31. On the left, you are seeing the bank statement. On the right, you are seeing the company cash book. And before touching anything, I always look at the closing balances. The bank statement is closing at $56,045, and the cash book is closing at $60,110. So right away, we know there is a difference of $4,065. The first thing I do is ignore anything that already agrees. If a transaction appears in both places, same amount, same timing, it's already reconciliated. Those items are not the problem. What we care about are the items that appear on one side but not on the other. That's where the reconciliation lies. Let's start with the bank side here. I'm only thinking about timing, nothing else. First, deposits in transit, $1,850. That tells me the company recorded this cash, but the bank has not processed it yet. So the bank balance is under state. For that reason, I add it. Next, outstanding checks totaling $1,300. These payments are already in the books, but they have not cleared the bank yet. So the bank balance is overstated. I deduct them. After those two adjustments, the adjusted bank balance is $56,595. This is now what the bank balance should be. Now I move to the cash book side, and this side is different. Everything here results in journal entries. First, missing receipts, $1,250. Cash came in, but the books didn't record it, so cash comes are here. Now, interest received, $120. Same situation, but recorded, but accounting didn't. So cash comes are again. Now deductions, bank fees, $65. Cash went out, but there is no entry, so cash comes down here. Now, non-sufficient funds check, $4,800. The company thought it got paid, but it didn't, so cash move is reduced and receivables reinstate. Finally, a small cash book error for $20. This is not timing, this is just a correction. So after all these adjustments, the cash book also lands $46,595, same number, and that's the signal. Now look at the journal entries. Notice what's missing. There are no entries for deposits in transit. There are no entries for outstanding checks. Those resolve automatically. Every journal entry here affects the cash book because that's the side that we actually control. Each entry faces something real. Missing receipts, interest, boundary check of an error. That's what a clean reconciliation looks like. So, bar reconciliation is not about forcing two numbers to tie. It's about understanding why they don't and deciding whether the difference is timing or something that actually needs accounting entry. Once you think that way, cash becomes one of the most reliable balance you have. And that's how I could review this in practice.